You're about to join Jerry Parker, Moritz Seibert, and Niels Kaastrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kaastrup-Larsen, are back with this week's edition of the Systematic Investor series, where each week we give you a raw and very honest account of what it's like to be a rules-based investor, what news and articles caught our attention, and of course, where we also attempt to answer your questions. First thing though, good morning, Jerry. Good afternoon to you, Moritz. How are you guys doing today?
Hi, Niels. Hi, Jerry.
Hi. Doing well.
Good. Sounds like there's a bit of a cold going on in Munich today.
Yeah,
Moritz.
That's me. Apologies.
That's you. Okay, cool. Now, kind of interesting week. Bit of a turnaround in the fortunes of equities. A pretty decent move up, I thought. Looking through the usual markets, obviously a weak dollar. But then the weak dollar helped, I guess, the energies advance this week. Gold made a new 52-week high, as far as I'm aware. And interestingly enough, despite this optimism in equities, the VIX actually recovered towards the end of the week. I think it finished around 16, so that was interesting to me. And of course, our favorite sector at the moment, the interest rates, had another week of strong showing in terms of price. Very low yield at the end of the week, inverted versus the 3 months. So that obviously may, certainly if you look back, I think someone mentioned somewhere that if you look back the last 50 years or so, this has happened 8 times where it stayed inverted for 10 days. And every time you end up with a recession within the next, 10, 11 months. So we'll see what happens. So yeah, I thought there was a few interesting things. And again, as we talked about last week, there's a lot of healthy moves when you look through the list of markets. There's quite a few of them that has decent moves now on a weekly basis, which is something we've, I think, missed and lagged a bit for quite a while during the last few years. So it's nice to see, but who knows how it all plays out in the world of trend following, of course, and no better place to start than with you, Moritz, to see how you fared through this week.
Fared great, I have to say. Up a bit more than 2%. And what you said is right. The returns have become more volatile. I'm definitely seeing that for the past 3 to 4 weeks. Daily returns are substantially greater than they were in the month prior. So whether that's a good sign or a bad sign, I don't know. But this past week, it's been good. I do have a small short position on in crude and Brent and in WTI, so that has worked out well. With the exception of yesterday, I think Friday was a bit of a recovery day for WTI. And, but the bonds, I mean, it's just amazing. They just move higher and higher and higher. It's relentless. We've marked a new all-time low in the 10-year yield for the German bonds. So there seems to be no end to that for now. Equities, strong week. I have a mixed bag of positions on there, some long, some short, probably still net long. So that has worked. And gold, yeah, I mean, long gold, interestingly enough, I'm short silver still a bit, but the long gold position that has worked really well this past week. And so with this week's performance, I'm back to flat. So I'm out of this.
Hooray! Great stuff.
I'm back at the black line of zero.
Yeah.
Which is good. I like that.
Worth celebrating for sure. It's funny you say this about the German Bund. I caught some of the headlines from this week's ECB meeting where, I don't know exactly what the negative rate is on 10-year Bunds. I can't remember, but the ECB was saying that it had, it has a considerable headroom, I think was the quote, to restart QE in Draghi's good judgment. But then I heard another great quote actually from a completely different source who basically said something along the lines where he said, the Fed may still have a few bullets in their gun, but the ECB doesn't even have a gun left. So I'm not sure how much room they really do have to do anything. So
I don't know either. It's about minus 30 bips on the 10-year, and on the shots, the shorter dated one, the 2-year, it's minus 60. So it's I like I just don't like that environment. I mean, I trade it as it comes, but this continuous environment of having negative interest rates, I just really don't like that.
It certainly shows you what an unusual environment we are in, and it also, I think, humbles us a little bit in the sense that even the three of us who've been around for a fair bit in this industry, looking at that period, it's still a very small period compared to just the history of markets, and therefore whatever we've experienced, it's not really that much of a guide as to how markets behave over the really long term. So anyways, before I get too much down a ramble, let me look at what's happened on our side this week. I would say overall also an okay week, certainly up for the month of June. For us, currencies were the big challenging sector, not least the euro, for sure. Also, just like you, Moritz, lost money in silver, made money in gold, so kind of a little bit of a divergence in positions. Grains, after a challenging week at the end of May, came back mixed to slight positive. Softs did okay. And then equities were actually okay as well, even though we've got a little bit of mixed positions there, but obviously still long the US. And then, as you, Moritz, fixed income, really the breadwinner at the moment in our portfolio. So even though it feels a little bit uncomfortable at these levels, and given the fact that I think 10-year US rates have dropped more than 1 percentage point now since November, that's pretty, and a lot of that has come in the last few weeks. So pretty aggressive on that side. But this is trend following, and we just don't know what's going to happen. So we're going to stay the course, of course. On that, I didn't really notice any particular changes in the theme of the portfolio, but obviously some reductions in certain positions given the quote unquote a little bit of counter trend moves we've seen, but that's about it. So, but interested in finding out, Jerry, if the world of single stocks behaved well for you this week, now with a little bit of tailwind in the equity sector.
Oh, sure. We happy I was able to maintain, sit through that volatility. I'm almost 90% long, so a few shorts and a fair amount of flat positions. So I think our portfolio is pretty diversified, all kinds of different companies, and the charts reflect that. So but you got to sit through that volatility, kind of like the grain market, where it became pretty obvious that corn and soybean, something was going on there. So corn had a massive rally. I got up the short, went long. Now those trades are kind of probably small winners or losers. And then soybeans, meal, and oil kind of going to do their own thing and go down a little. So we're just wondering about the wheat, what's going to happen there. Is it going to follow corn? It's kind of like one of these obvious trades. There's not enough planting or something going on, but the market's like, not that obvious. Give you your corn trade, run you out of your shorts, make you get long at the highs. So if it's so obvious, the market is just sort of, even in corn, just kind of sitting there, not behaving like the fundamentals would indicate. So focused on those markets and lost money in the dollar, of course. Got a few longs anyways, like Mexico and Russia, India.
Okay. Didn't know that you traded the rupee.
Yeah. Like interesting. I like having the gold long and the platinum, silver short. I think that's. We had a tweet this week about diversification and forcing yourself to get into markets other than stocks and other than bonds. Of course, what's left besides commodities and currencies, really what we trade and how we trade them. You can add them into your portfolio safely, and they'll probably produce some sort of positive return. But I think you really need to, do things like that. And the CTAs have such an advantage and an edge because we are basically including markets that may not have really been that great historically, performance-wise, but they're in the portfolio due to diversification. And then we wrap the trend following around it, and boom, they're kind of profitable. At least we think they'll be profitable. We're choosing what's the next great trade, what's the trade that we're looking for, what's going to perform next. Well, whatever meets our entry criteria, it's in an uptrend or downtrend. So that is pretty fun, to and so we just desire. I like to have some shorts on in a big uptrend, or have a long gold short silver. That's fun. Not as much fun to be short all the grains or short all the base metals like we are now. So we love picking up that diversification and seemingly contradictory positions.
Yeah, no, absolutely. We're going to talk about what happened in sort of the tweet land this week, and see what people liked and disliked. Before, maybe I'll just quickly give an update on the live event that we have been talking about mentioning, and so yeah, I mean, very much appreciate all the feedback and the people who have raised their hands to get the final details from us, which of course you can if you send an email to info@toptradersunplugged.com. There are still a few places left, of course, but it is first come, first served basis. So those who have now the information, or those who want it, you do need to come back and sign up, commit. Just, I think yesterday, we had a commitment from a gentleman all the way from Australia, which I think is amazing, fantastic commitment. Someone who wants to come and spend a couple of days with us in October, 26th, 27th of October in New York, and is willing to come all the way from Australia to do so. That is just outstanding. So much appreciate all the interest. And now we just need to fill the last few seats so we can confirm everything to everyone. So hopefully you will all find time to do that as soon as possible. Let's talk about what happened in sort of your interactions this week, Jerry, on Twitter. What are the themes that people are talking about? I was just looking at the sort of the year-to-date market moves, and there really has been some interesting moves. I mean, both Lean Hogs and RBOB is up more than 30% for the year. We've got lots of other energy markets up close to 20%. Equities, of course, we know, sort of 15 to 20% up. Bonds up 4-5%, which is amazing for a bond. And of course, on the downside, things like natural gas, live cattle, and orange juice been hit pretty hard. So lots of things going on. So hopefully that reignites the interest of global macro, and ideally systematic global macro, like we do in the trend space. But what are people talking about in your Twitter exchanges at the moment?
Well, actually, what you just said got me more fired up than Twitter. So
Good.
I think that's worth discussing. Unfortunately, you may not like this where I'm going here, but I think that's a very interesting list that you had there, in the sense that so often these percentage trade moves don't translate into profits for us.
That's right.
Yeah. I mean, so like stocks had sold off so hard in December, and we were like flat to short some, and especially if you're looking at the indexes, and then they rally from like a low. That's no good for us. And then we've had some big moves, I think, percentage-wise. You mentioned some, like maybe cattle or things like that. And so since we kind of size our trades based upon the volatility, this huge move in percentage terms, it doesn't translate into much. But contrary to that, small percentage move in the bonds, that translates into a lot. So it's just kind of funny that if you don't look at the chart, if you don't look at the ATR or the volatility and understand the sizing formulas that we use, then you're like, well, something's up 100%. Why didn't you make money? Well, because that's 100% from a very low point. I buy the upside breakout. Well, then the bonds are only up X%. How come you made so much money? Well, their volatility is low. That chart worked out better for our systematic approach. And then we slammed on a ton of bonds because of the vol was low. So it's pretty funny how these percentages don't really always mean a lot.
No,
for us.
I agree completely. And one of the things that I guess as an industry we've said over and over again in the last many decades is that the truth is we only really need a few really good trends in a year to make the money we need. So I'm just right now pulling up all the attributions for us so far this year. And frankly, the money has been made in one sector. All the other sectors are either kind of small losses or small gain, nothing to write home about. Most of them, actually, I would say, are probably small losses. But there's just this one big sector, in this case, fixed income, that is pulling the weight right now. And so I think it's so important to what you said, because I think a lot of investors feel that, my trend follow, they just need markets to move. But actually, we don't just need them to move. We need them to move in a direction. And ideally, we need to position correctly, or the trend needs to be long enough for us to get positioned correctly to make anything of it. But then again, back to the discussion about diversification, because we are so diversified in our approach, we have lots of strings to play on, and we only need one or two of these strings to have amazing moves. I mean, even this year, where you could say, as you started out by saying, I mean, CTAs we were not positioned correctly for equities to go up 20% in the first few months of the year, for sure. We were not positioned correctly for some of the moves in lean hogs in March when it went up 75%. So there's been a lot of challenges this year, yet the industry as a whole is, having a positive year so far. But yeah, no, I did this. Those are interesting points. With your cold, Moritz, are you able to share your thoughts?
keeping the mic on mute most of the time, so you don't hear me coughing. But everything you said is correct. Sometimes you only need one big move, one trend. We need markets to trend. The move in itself is, whatever the definition of a move is. If it's a choppy move, then it doesn't really help us all that much. And normally we get kicked out of the position with a loss. But, one nice trend can pay for all of those small losers that we have in our portfolio. So it's important to keep that in mind. And also what, Jerry said is so true. The volatility, the percentage returns of those markets, it's really the wrong benchmark for us, because the 75% in lean hogs, no CTA will make 75% from lean hogs. It's just not, that market is so volatile. Our position size is going to be relatively small. The market isn't that liquid to begin with. So, and the trends in lean hogs, I mean, they're normally, in my experience, they're not straight line trends. They're fairly choppy trends. It's not an easy market to trade, but this is not the best example. We had this massive move up in March, April, and I think now we're almost back down to where it started. So it's on both sides of the coin. Difficult to trade that one, and also, like you, Niels, in my trading, it is all about fixed income this year, and it's again one of those mind-boggling things where pretty much every year, 31st of December, you go, well, bonds have done so great. That's not going to happen again. They're at negative yield territory. They can't go any higher. And boom, surprise, there you go. Next year, the bonds again, making you the most money. Kind of amazing.
Yeah.
Well, I wanted to chime in on that earlier conversation. It's really weird because how they can go negative, and you were talking about the ECB and the bullets and stuff like that. And I just think that it just reminds me of so many other conversations about how people will say, we're just in this territory where no one could have predicted that this could even happen and what the ramifications real time are going to be. And we're still set in this situation where we don't know what the consequences are going to be. What if we look back on this like we did 2008 and say, this went on a long time, seemingly without nothing negative. Stocks were doing great and economy was great. But now we see that there is this really downside to these negative rates. And the power that it looked like these central banks had, they really didn't have it. It was just a delayed reaction, or that doesn't occur. I just think it's just kind of a weird situation where no amount of experience would have. And then even if we had an experience, let's say in 50 years we go through this again with negative rates, is it going to be the same as this experience? I'm just so happy that I'm following these trends.
But and sure, and that's absolutely true. And this is why it's a little bit mind-boggling to me sometimes that investors, have so many reservations about, trend following as a concept, as a strategy, let alone having it in their portfolio, because we, even the three of us, and therefore probably most of our listeners, we've all gone through experiences in our trading careers that are unusual, and so, as you say, Jerry, even if it happens in 50 years from now, well, we won't be around, and so the next generation, they may not have seen this, so it's going to be new for them. And so, if you don't have any reference point, you're going to be, I would think, confused and uncertain. And I think it's the rules that give us certainty. It's the rules that give us confidence to do what we do. And I'm not saying, even though I don't want to go back to our discussions from last week, Jerry. I'm not saying that everything you own should be in trend following. But I am saying that I think it's
you weren't saying it last week, so I know you're not going to say it this week.
But it is important to have, to have it as a core, investment in your portfolio. And I was listening to a guy who called a doctor, Daniel Crosby. Or Crosby, I'm not sure. He wrote a book. I haven't read it, but I think it's a great book called The Behavioral Investor. And I was listening to some of the things that he was saying this week, and there's so much evidence that he's found in terms of, some of the best things you can do is actually do nothing, right? People who are active, who trade in and out, all of that. I mean, their returns on average are 2-3% lower than people who are just, in it for the long run. They structure their portfolio and just stick with it. And so, and of course, we as trend followers, yes, we are active, but we're not short term. We're not high frequency. We're pretty low, in terms of activity. Most of the days we don't do anything. Certainly in one market, and maybe we have 3 or 4 trades per year in any one market. And apparently, according to all this analysis that they had done, that wins, that approach wins. Like we've seen, obviously, people who have just stayed, for better or worse, just stayed long. That has worked, compared to just active long, active equity funds. So we'll see.
Well, yeah, I'm surprised. You said like 10 things I wanted to comment on.
Yeah.
So it'd be difficult for my memory to remember them all. But I'm surprised that people are not more humble, that they see these things happening and they can't predict it. So why don't you just go with the trend? And no one, I say this a lot, but in different markets over the years, I've said, no one is dumb enough other than the CTAs to stay long bonds or stay long stocks in the face of all this overvaluation. And, valuation is not good at predicting. Everyone believes that, but why are you still long? Because trend is a good way. But I think what I meant by the 50 years from now is it doesn't matter that they didn't live through it. They shouldn't take any lessons from it. My point was today, with negative rates, this is what is occurring. Is the same thing going to occur 50 years from now? I don't know. Don't remember any of this. You're at an advantage if you don't remember, if you weren't born, as long as you're following your system.
Yeah, absolutely.
Follow that trend, because the rest of the world is saying, oh, we know what's going to happen. Mm-hmm. I was around, or I read history books. I looked at charts, and this is how the world works. And we're like, no, I don't know how the world works. You don't know how it works. It seemingly works differently all the time. That's why we just want to follow the trend.
Exactly.
Some people might even say, I remember I was listening to Moritz, Jerry, and Niels, and they were saying this.
Yeah, the point, look, I mean, I love what Jerry just said there. Like in 50 years, we may have a Fed coin, electronic money, whatever, right? So maybe there's not going to be any cash around that you can take out of a bank and put somewhere to avoid negative interest rates. Maybe you're forced to take them, right? So things change. We don't know how the system's going to work in 50 years, but we can at least rely on those rules. And like I need to make a confession here. Like a couple of years back when the German yields for the first time, in modern recording had a negative yield, I was like, well, I don't like that. I don't like being long those bonds, because I don't like being long things that, pay a negative yield. That just doesn't compute. And so, I was looking at my system, was trying to, reduce the position size on those bond positions. And, until I, cried uncle and gave up on that. And I think it's been the right decision. It didn't take me long. And I just, decided, well, I know absolutely nothing about this and how this is going to play out. Because what I've remembered all those people telling me at the time when, the Bund was paying 5% and then starting to move lower and lower and lower during the course of the European debt crisis, that zero must be the natural floor and that it cannot go lower than zero because the central bank politics isn't going to be that expansive, right? Well, guess what? It happened, right? And then people said it's not going to go, more negative than minus 20. Look, the thing is, if somebody, made the point that, what's the probability of German Bund, 10-year Bund yields yielding minus 5%? Would you really say the probability of that is zero? I will no longer say that. And I'm sure 99% of the people out there will say that's impossible. That will never happen. But we've been surprised so many times in our lives because the thing just always changes. It's never the same. The future always unfolds in a way that's kind of like different to what you thought is the rational way. And therefore, I do not make those predictions. I just follow the system. And if they go to minus 5, then I'll probably feel pretty bad about that because I don't like that environment when, the thing's at minus 5. That affects all of us. But as far as my trading is concerned, I do not allow my system to have a view on that. I'll just objectively follow that. If it goes to minus 5, so be it. Then I'll be massively long. Well, that's the recipe for the portfolio, which I like. And everything else, we can talk about and have those macro discussions. And, maybe some people know things better than we do. But as far as my portfolio is concerned, none of that has any impact.
No, indeed. Yeah, well, that was a bit of a confession you came out with there, Moritz. Thanks for sharing.
Well, yeah, because, we all sometimes spoke about when do you make changes to your system and, how often do you play around with it? And it's like what at that point, I was looking at those bonds and they're starting to go negative. And it's kind of like, yeah, I don't want to be long them at negative yields because I also thought that maybe this is a natural floor. Maybe it cannot go lower, right? And then you start playing around with the thing. But like I said, I mean, it didn't take me long to just go back to the default setting and the original setting and just trade the bonds as in the same way I always used to trade them, and just not care about central bank politics.
No, and the reason I highlight it is because I think it's one of those questions that one we get a lot in terms of when do you make changes and all of that. But also what I really illustrated and use it as an example is that for the three of us and for everyone else in our industry and many other industries, it's a journey. I mean, it's not like we have, you wake up from the beginning of your career with all the answers. I mean, it is trial and error. And trend following to me has always been something where you need to find all the things that doesn't work until you find the things that work. And it's not about perfection, but it's, good enough is good enough. So yeah, I mean, that's part of your journey, and it's been part of our journey and Jerry's journey. You try things to see if it makes sense or not. But you often, interestingly enough, end up kind of where you started, at least in terms of principles, and treat everything equal, keep it simple, etc., etc. So interesting. Were there any activity at all in Twitterland this week, or should we continue our freestyle?
Well, we sort of talked about diversification. There was a couple of tweets about that and about how people think about it, diversification sometimes, but they concentrate their bets on what's been hot, which is doomed to turn around. And so, thus, I was sort of saying earlier that the CTA approach is to ignore performance historically, put the markets in the portfolio to the degree that they improve your risk. And then when you wrap trend following around it, you have some longs, you have some shorts. That the short piece helps with risk as well. And we don't even desire, like, honestly, when you think about it, I know I don't desire to be long the best stocks right now, ever. I know in 2013, my stock portfolio was just amazing. It was a big up move, and then I had all my stocks, like almost every one that I had, I was long all of them. So now I think I've improved, quote unquote, my diversification, because now in this kind of up move, I have shorts on and I have flats. And so I'm really great at that. So we're really odd people in that we are so focused on diversification and hopefully getting longs and shorts in the same sector, liking the idea that we're long gold and short silver, and without any regard whatsoever for the majority of people are like, well, how can I take this technical approach or this trend following or any approach and find the best performing equities or markets? We're like, no. We don't need to do that. We don't want to do that. We kind of want to always have this sort of hedge position. So I think that's kind of interesting and different.
Absolutely. Yeah.
Because trend following trades, they all make the same amount of money. The longs and the shorts are equal. So we're not sacrificing anything.
That's interesting. You mentioned that. Sorry to interrupt you, is because that's not what I have found, and I don't think it's something we've found. I mean, and I know you and I have touched on this maybe years ago, and I think it's one of those. At least this is my opinion. Our finding. I think it's one of those things that people may not be aware of. But if you ran a simple 50-day, 100-day breakout system over a long period of time in a diversified portfolio, my suspicion, at least that's been my experience, is that you find that most of the money are made on the long trades. And I've always thought that, and this may be completely wrong, but I've always thought that maybe it's because the way markets turn. I have found just from looking at markets that when they make a high, they tend to take longer time to make that high. But when they make a low, like we remember everyone in March of 2009 with equities, it kind of one day was the low, and from there it was just straight up. And so, but I think the shorts are important because they tend to make money when you need it the most, so to speak. But I have not found necessarily that long and shorts make equal amount of money. But what we have found, or what our belief is, that that markets should, over very long periods of time, give you more or less the same return, meaning whether it's a commodity or whether it's a financials or whatever, markets on average should give you more or less the same return. But we haven't found that on longs and shorts, actually.
So Moritz is going, oh my gosh, Jerry got him again. I sucked you into this argument.
No. I mean,
that's my whole idea.
I'm enjoying the front row seat with you guys.
Yeah, that's my whole idea, is to say these provocative things.
Yes, and to make sure I listen. You're actually just checking that I'm still here.
No. I'm using. I want you to bring this up.
Okay.
I'm trying to make this crazy statement that, as you say, it's not true.
Yeah.
But how can you think it's true? Why do you say it's true when I totally agree with what you said?
Yeah.
100% I agree.
Yeah.
So the reason is because it's back to sample size again.
Yeah.
In order to get the requisite sample size, we have to trade all the markets the same and the longs and shorts the same. And we take from that back test the average win, the average loss, the average win divided by loss, the winning percentage.
Yeah.
We get those numbers from the longs and the shorts. But historically, once again, this was I think our biggest difference last week was you were talking historically and I was talking in the future.
Mm.
So historically, what has happened. All the markets have not made the same amount of money. The longs have been better. Everything you said is 100% true. But taking this systematic approach and this back test and saying, what are you going to do for the future? What are your assumptions? We are forced to assume that the average trade in the back test, when we choose our systems and we choose our expectations for the future, our best guess is to take the average of all the markets, having treated them all the same with the same parameters and systems, and the longs and the shorts. So that's why we say they all make the same amount of money. They all have the same expectation for the future. Historically, no, not true. But yeah.
And that is so true, and it's very important because that is why we end up actually treating, or I think a lot of trend followers end up treating all markets equally, even though we know, of course we know, that some markets would do better with certain parameters configurations and other markets would do better with other parameter configurations. But as Jerry says, because we don't know what's going to happen in the future, and that is our core belief that nobody knows that, we can't just, based on historical performance say, oh, so I'm going to change my system and do that instead. No, that doesn't work.
That's right. Optimizing for the market or for the long or for the short. We can prove without a sample that it doesn't work. The best parameters for corn or any market from 1995 through 2005 are what they are. From 2006 forward, has that been the best parameters? I doubt it. Your best guess going forward is the whatever worked best for the whole group. I want to hear Moritz break it down,
Moritz.
So much to break with you guys there.
Please tell me I'm right, Moritz.
Yeah, you are, and it's that's exactly how I look at the thing. And I'm not using different parameter sets for different markets. None of that, right? Exactly. And I think Neil said it perfectly. Nobody knows how the future is going to play out, and what we've seen in the past sample size, the realized sample size, the history, that's one draw. There's nothing to tell us that the future is going to look in that same way. So optimizing for that is not what I want to do, even though, and here I say it, there's a couple of funds out there, friends of mine, who do that with good results and with conviction, and they wouldn't want to hear what we're saying. There's people who look at risk-adjusted returns of certain markets over the past 1, 2, 3 years. So say the bonds, right, probably produced the best risk-adjusted returns over the past couple of years. And they would then, tilt their weights, their exposures to those markets. So in this example, they would increase and start overweighting the bonds a bit vis-a-vis all the other markets because those markets have produced the best risk-adjusted returns in the past. And so when you look at the time series, they can show that there's value in that. And so then, I have that argument just like you guys just had it is, well, you may have been optimizing this to the past, and whether that's going to play out in the same way in the future is just, you don't know. The answer then is, well, but it does work. And that mutes the conversation.
But Moritz,
so it's a philosophical point, really.
Yeah, but can I be devil's advocate, sorry to interrupt here, because I think this is an important point, actually. What if these guys had a rule? What if they automatically were doing all of this, systematically doing what you're saying? They look at, certain historical, and I know we may not have any, we may not have had any positive experience with trading, quote unquote, the equity curve, which is slightly what they do. They tilt according to profitability. But if they had rules to do so, meaning the portfolio would dynamically change over time based on fixed rules, I wonder whether that would make it a little bit more okay, so to speak. It's a question. I don't have an opinion about it, so it's just a question for you, whether if you can rule-based stuff, it's okay not to treat everything completely equal. I don't know. It's just a question.
Yeah, I see where you're going. I see where you're going with that. I mean, obviously it would be great to have rules for everything, right? And I like that. The more rules, the better. But I'm also aware of the fact that you can design and come up with bad or inapplicable rules, bad in quotes. And not every rule that you can put into a trading system is probably a good rule. Let's have a look at take for example the S&P 500. If you equal weighted the stocks in the S&P 500, you'd get better risk-adjusted returns compared to the S&P 500 as it is today, right? So that's kind of like the naive statistical approach of not having too many parameter sets, treating everything in the same way, gives you in this example even the best returns. And this is kind of like how I want to look at my trading system also is I don't want to be implementing any expectations about future market behavior, not even with a rule, into my trading system so that I start becoming overexposed to a certain sector or market only because it's done this and that in the past. I kind of like want to show up every day, every year, every decade with the same set of things, the same objective, unbiased, neutral definition with my system and play again without having tilted my exposure, one way or the other.
Yeah, no, I like that.
Yeah, I mean, I'm not a fan of rules for rules' sake, especially these days. It's systematized discretion. When I used to sit in front of a quote machine and do a non-system trade because I was panicky but that's obviously wrong. But now if I could just program it in with a rule and I promise to do the wrong thing every single time, no. So trading each market differently is fundamentally incorrect. In your world, it can be correct. I'm okay with that. If anybody else out there wants to have that as, no, I optimize for every single market. There are Republicans and Democrats. I'm not going around telling the other party or people who disagree with me politically, no, you're 100% wrong. So you can do what you want to do. You're not going to be successful. People will try to give you advice on this podcast and we'll try to lay it out for you, starting with sample size and moving forward as to how critical this is to trade them all the same way. You're free to reject it, and people reject great ideas all the time. And people who are so sure of their ideas, like me, they're frequently wrong. So I'm not interested in making sure everyone, not out to save the world, but you don't have to do any back test. It has nothing to do with whether you have this as a rule and it's systematic and you treat the market the same way every time. I think most people who know anything about how this works mathematically, they're going to tell you trading your equity curve is not a trade. It's not a part of a system. There's no sample size there. Trading each market differently is not going to work. I mean, you can do it, but it doesn't matter. Obviously, if you can program and you can systematize it, you're probably going to do it. It's not going to make it any better. Mistake is a mistake. Doing things the wrong way. We've all done them.
Mm. Were there any things from your side, Jerry, in your exchanges on Twitter? Anything article wise? I know we also talked about that there was an article we all sort of skimmed through from I think it was from Goldman Sachs when the trend is your friend, momentum in commodities.
Yeah, it was a good paper. I didn't get a lot out of it except that these are really smart people extolling the virtues of trend and backtesting and explaining how trend following can help. A 12-month look back can make get you in the right position and then reduce the drawdowns. But it did seem, once again, too much thinking going on. You're really at a disadvantage if you're too smart sometimes. And they were they were sort of classifying each market or each sector, saying, well, it doesn't work that great for this sector, but it's better for this, stocks, it's okay, but for these couple of commodities, soybeans and something, it didn't work very well. So you may want to adjust things a little bit. So it goes right back to what we were talking about. No, you're not going to adjust anything. You're getting all this data, all this sample size. What on average works the best for all of these markets? Long and short, I'm not discriminated against them either. They're all just a trade in order to build up as much evidence as I can. And I'll leave the optimization and being very specific to others for something that's a lot less accurate on any individual trade. But over time, my evidence is greater that it should perform well over a long period of time.
Yeah. I mean, it kind of goes back to sort of this podcast I was listening to this week with Dr. Daniel Crosby, where some of his evidence, and he comes to the behavioral finance as a trained, he's comes from the medical side before he got into the world of trading. But one of his findings or some of the research that he quotes is, of course, that the more information you give people, the worse they become to make decisions. And in our world, the more information you put in front of investors, the worse their performance will be. And to me, that's interesting because, again, there's been this quote unquote trend in recent years that big data must be better than how we trade, still just looking at the open, high, low, close every day. I mean, that's it. That's as big as it gets on our side. So there are these biases always pulling us humans in different directions, and so this simplicity, which we find so hard to accept, can be more robust and in our case better performing than these very complex trading approaches that we hear about, at least.
Simplicity doesn't sell well.
No, it doesn't.
You need to be complex and smart to raise assets, I feel.
Yeah.
And what's the downside? What is the downside of buying that bond at a negative rate? A small loss. Yeah. Small loss. That's it. That's it. That's all it was. 25 basis points or 45 basis points. And so we have it so misplaced. Now, ego-wise and, God, I can't believe I did that. I knew it wasn't going to work. Why don't, of course you got that. But money-wise and math-wise, that's the way we do every single trade. What's the consequence of doing something that looks pretty silly from a traditional valuation point of view? So small.
Mm-hmm. And that's you mentioned ego, and actually I think in his book, and as I said, I haven't read it myself. I'm just paraphrasing, things I've heard. But I think he distills down, or he mentions that there are like 177 different biases that we have to deal with and overcome. But you can really distill it down to 4 main ones, and the biggest of those 4 is ego. I mean, that's our biggest problem, so to speak. Like when you ask people, how many of you think you're a better driver than average? I mean, most people will raise their hand because they think they're great drivers, but probably not the case. So It's so interesting because it's so simple. What we do is so simple, yet it is so hard for people to buy into.
Yeah, but the complex part of what we do is keeping it simple along the way. Because, there's also, in addition to all the biases, and, we know about them with our experience trading, there's always this thing of the grass is greener somewhere else, and I should be doing something about my system and change it, and other people are making more money. My neighbor is making more money than I do. The other trader is making more money, so I need to catch up. And so you're constantly driven kind of like in this, well, I need to change. I need to become more complex. And if I'm more complex with my system, I'll sound smarter because all the other guys sound smarter out there and they have an easier time raising assets. And I sometimes think all of us guys, you guys, we deserve the fees and the money because over time, we can stick to a simple system and not give up. And that's a lot of value there.
And you know what? That is another thing that he quotes. And I think this is super interesting. So they did another study where they looked at whether investors who used a financial advisors did better than investors without a financial advisor. I'm sure financial advisors get a bad rap from time to time, but the point he was trying to make is that actually people with a advisor, let's call it that, someone who would be there to hold their hand and make sure they didn't make any bad decisions, etc., those portfolios on average per year would perform almost 3% better than people who were just willy-nilly doing it on their own. And we all know how much 2 or 3% compounded can make of a difference over 30 years. And I think the other role we play, forget about returns sometimes and stuff like that. The other simple role we play, along with other funds, of course, is just to be that filter or that, hand-holding entity, as part of your portfolio, that allows you not to do stupid things. That's part of the fee we get paid, in my opinion.
I agree. And it's an important part.
Yeah. What else on your side? Actually, we can take a couple of things.
I have one I really like.
Okay.
So this is one of my favorites of all time from Morningstar, which is this was something I tweeted May 31st. It's a study or an article from Morningstar. I'm not going to look it up, but I obviously took out all the best parts, so you don't even have to read it probably. But it's kind of funny in that someone is, I don't know if it was the author or he's writing about someone on purpose tried to create a bubble portfolio. These are a group of stocks that basically everyone agrees are in a bubble. So let's see how let's track it, talk about it, criticize it. Let's just track it. So it says it made 80% for the rest of 2017, dropped 23% the following year, and rebounded to gain 17% so far this year. That makes for a 25% annualized return. Then he quotes, this is not surprising. Bubble, after all, is but another way of saying investments with positive price momentum. And investments with positive price momentum enjoy a long, long history of success. I love grabbing pro-trend following things from people who are stumbling into this, from a stock or mostly value fundamental point of view. And I say at the end, I create my own Twitter tweet for rarely do I do this, but I say, bubbles, outliers, mega trends, 100 ATR moves, whatever you want to call them, they're all the same. Trend following doesn't work without them. And with them come along the skeptics and the doubters. So that's hard to deal with, that this is what we have to wait for. This is what you're telling me. What if it never happens again? It doesn't look like it's happened in a long time. And I'm like, yeah, that's in order to preserve your capital and take these small losses and stay with a very diversified portfolio of longs and shorts. Then you just sit and wait for the mega, the one that scares everyone else. And they're trying to get out of it way too early.
Yeah, I mean, it goes back to sort of really basic principles. And of course, this has been a while since I was in school, but I do seem to remember Newton's law of motion, right? That, things or an object that is in some kind of motion will remain in the state of motion unless you have an external force that comes in. So, so the whole idea of something that is moving in a trend is more likely to continue to move in a trend, which is what we're trying to exploit, is pretty basic, and it is recognized as being true in science and in many, places where that apply. Yet in our industry, it's almost like, I'm not so sure it really works. Why do you think it works? And we have to jump out through all these hoops to justify what we do, despite the fact that as one of very few investment strategies, let's call it alternative investment strategies, there are 50 years plus worth of actual track record data out there. So another contradiction, in my opinion, as to why it is so hard to convince people that it's a good idea to have a little bit of trend, so to speak.
Ooh, a lot of trend, not a little bit.
Anyways, while we're talking, one of our regular listeners, I think I can say, Brian, he was just sending me an email about an interview, just to completely change tact here, but he was sending about an interview on Real Vision this week, called "Who's Selling Volatility and Why?" And so I was just going to throw it out to you guys, whether any of you had watched it, and Brian asked if we want to had any thoughts about it. But I have personally not watched it, so I'm not so sure who's selling the volatility right now.
Yeah, I've watched it. One of the things that I absolutely love, it's kind of like my start in trading. My background there was trading and hedging those products.
Okay.
Autocallables, down and inputs, all of that, type of stuff. So there was an article also in the Financial Times this week called South Korea, the powerhouse of autocallables. So South Korea is also one of those markets where they had, for a very long time, substantially positive interest rates. So people, were putting money into bank accounts and safe deposits. And that has changed. Their interest rate is also much lower than it used to be. And people are buying, structured products as a yield enhancement trade. So what the article there was about is that in years prior, people in South Korea, but also in Japan, they have purchased those products with reference to their own domestic equity indices, the Nikkei, the Kospi, right? But over time, this trade has expanded, and now the products in Asia are also referencing European underliers, such as the Euro Stoxx 50, or US underliers, such as the S&P 500. And also the industry is still relatively large in Europe, especially in Switzerland and Germany. Not as large as it used to be in the heydays, like 10 years ago, but still greater than 100 billion in assets in the case of Germany. So what happens there is it does have an impact on the volatility curve, right? And people comment about this, and the session on Real Vision was also about this, is that the way volatility is traded impacts the volatility curve, the term structure, at different parts, right? So there's kind of like VA hedging, variable annuity hedging trades going on at the longer end of the S&P 500, for instance, keeping the S&P 500 long-dated vol relatively high compared to the front end, where there's a lot of, VIX selling going on, roll down plays, exchange traded product linked to VIX, inverse VIX, all of that keeps the short end of the vol curve suppressed. There's some other effects going on in Europe. For instance, you may contrast European volatility markets as measured by the Euro Stoxx 50. There's only 50 underliers, so a tenth of the S&P 500, which means that the Euro Stoxx 50 should trade at a higher vol, theoretically, but it doesn't. It trades at a lower vol because in Europe, pretty much vol is sold across the board, right? So those things are interesting to watch. I enjoy them still. It doesn't really have to do anything with the way that I trade with my system, but kind of like brings back the memories to the old days, and observing what goes on there is just fun to follow for me.
Good stuff. Well, that is almost like if we were doing live streaming to put a question like that and get it answered straight away, Brian. Even though you probably won't hear this until a few hours from now, but we appreciate that. We've got another question, interestingly enough, that's also to do with volatility. It's from, not Brian this time, this is from Ryan. Appreciate the question, Ryan. So Ryan writes, you have discussed doing some trading in the VIX and how it's unique because it doesn't really trend. I'm assuming the strategy is more mean reversion, seeing as VIX is just a measure of SPX options volatility. Couldn't strategy be expanded to work on any other liquid options market? I find trading volatility quite interesting because the return seems to be rather uncorrelated to a traditional trend following strategy. Thanks, Ryan. I mean, I can go first on this one because I don't know if any of you guys are trading the VIX. We are, but I think where Ryan is coming from is that I probably mentioned that is the only thing we don't trade as a trend follower. We've not found any ways to do that successfully. I think maybe if you're a short-term trader, you could, but as a long-term trend follower, we can't do it anyways. So we trade it differently. We're looking for different things within the VIX. We're trying to find anomalies. We're trying to find mispricing in the curve, et cetera, et cetera. So it's a very small allocation within our program, but it is the kind of idea of what you're saying, Ryan, is just to explore and get see if there's some more we could do, maybe from a shorter term perspective in terms of trend following in that space. But that's where we're coming from. But as I said, it's not a big thing for us. But I think you are right that if you do find a methodology that works, and even if it's mean reversion, why couldn't you apply it to other markets? I'm sure you could. But that's obviously guesswork from my side. But anyways, what about you, Moritz? Since you're the crypto guy, you're the most out there of the three of us. You may also be out there with the VIX. Who knows?
No, I don't trade it. Sorry to disappoint you.
I would like to trade it. It just doesn't core. I'd like to have something that would help me with my volatility of the stocks. It seems a diverse portfolio of stocks is very diverse 90% of the time, and the other 10%, they all go down and they get crushed. And maybe you were able to hang on, or maybe before they rebounded, or maybe you wish you wouldn't have hung on waiting for this rebound. But when I've looked at this VIX thing, it seems that, like there's been February of last year, there's a big sell-off, VIX spikes, but then when the volatility settles down, all the profit has gone away, and I'm still stuck with stocks that are now in a big drawdown. So I don't need VIX to help me with my stocks. And to some degree, when these stocks keep rallying, this is the sort of Achilles heel of crisis alpha in any shape or form. It's not really a crisis too much if the market kind of rallies a lot and goes right back to new all-time highs. But for us, we may have been bounced out due to our stops and stuff. I talk to friends who trade this. They tend to look at it's this in a discount or premium. If the futures is below the cash, maybe that's a good time to buy. I don't know. It's not, you can't, trend following doesn't seem to work with it. And so then I'm not interested. If trend following is not going to work, then I'm not going to mess around with it.
Yeah. Did you want to add anything, Moritz?
No, same here. It's exactly for that reason that I do not trade it. It's extremely mean reverting market. That's the nature of volatility per se. So, you would have to trade, I presume, a super short dated trend following system, which is not what I do. And even if that works, it's questionable. So it's just not one of the markets that I have in my portfolio. But, you've said I'm the crypto guy. I think Bitcoin and all of those things there, they can be extremely trendy. There's not a lot of history on those, but very emotionally driven market, lots of retail people in there. I mean, I think that's a good addition to the portfolio, and there are trends, so let's do it.
Oh yeah, we're
much different than the
VIX. Yeah, you could throw all of those labels on us. I mean, it used to be kind of not that funny or welcoming from my point of view, but whenever I'd walk into a meeting, oh yeah, you guys trade pork bellies. Oh yeah, okay, whatever, and Swiss and yen and gold and S&P and soybeans and respectable markets as well, whatever. I mean, if we've seen one thing about the Bitcoin, that is it can have a hell of a trend. So, boy, call me a Bitcoin trader then, crypto or whatever. But, what I really am is acquiring diverse assets in my portfolio and throwing trend following on top of it because I'm nervous and I want to protect my capital.
How far away do you think, Jerry, that you would be from adopting, say, Bitcoin into your portfolio?
I'm ready. Like every single decision like this, it just two different things. One is it does it add diversification and is it liquid? And so I'm ready. One of the things I have to talk to Moritz off air, but to see what he's experienced in some of the plumbing issues. I know that, for instance, the margin can be a little larger or a lot larger than what we're used to, which is not a problem for one market, let's say. But I think maybe the margin is 5 times as much on a long trade or whatever. But I think the shorts, they try to discourage the shorts. I'm not sure if that's what you've experienced, but and just trying to put it on our trade sheet and get ready to trade it. People are sort of nervous about a short position, I think. I'm not sure.
Yeah, you should. Everything you said there is correct. The margins are higher than for other markets. Even though I've seen them come down. I remember when it started 1.5 years ago. What was it? December 2017, I think, is when the contract got launched on the CME, or first on the SIBO and then a week later on the CME, and they had an initial margin requirement equal to the notional contract value, right? So 100% margin. That has now come down. But like you said, I mean, our margin to equity ratio is, we have enough cash, to have one market and pay up for the margin there. So for me, this is not that's not a roadblock. And then, we can talk off air regarding the other plumbing and, what prices you can hit and when. But it's, summing it all up, it's nicely tradable. So I didn't see any problem with it.
Absolutely. And on this show, we love the CME group because we have all traded there many times. And of course, as many of you know, they also sponsor some of the other shows on the podcast. I was going to run through just where we are, state of the Cta Indices after the first week of June. Maybe if you want to think of anything else to bring up, we could do that afterwards. But what I have seen as at the end of Thursday this week, we're seeing positive performance across the board. BTOP 50 index up 38 bips, up 3 3/4 on the year. SocGen Cta index up 56 basis points for the month of June, up 2.79 for the year. The SocGen trend up 0.5%, up about 5 for the year. The short-term traders index is trying to get back to even for the year. They're up 70 bips roughly for the month of June, down 1.14 for the year. And the Bridge Alternatives is up about 0.25% for the month so far, and up a little bit more than 4% for the year. Now, before we talk about maybe some final points, I want to make sure I I announce that next week we're going to have a very special guest on the show, Corey Hoffstein, who has written some really great stuff. He also has podcasts, and I think our conversations will be super interesting. for all of you. So that's going to be next week. So if you could target your questions maybe and make them more relevant for Corey next week, then we'll be happy to bring them up, of course, as we always do. But I just wanted to make sure you are aware of that. And actually, a couple of weeks after we have Corey on, we're going to have one of our good friends on the podcast as well, namely Salem Abraham. He's going to join us at the end of the month. So if you already want to think about some really hard questions to ask Salem, that would be, of course, great as well. Anything else we want to bring up this week? Anything from you, Jerry? Anything you just want to make sure we get in this week before we finish?
No, I can't think of anything.
Good. Moritz, you're okay on your side?
No, all good.
You're all good.
Happy trading.
All right, good. Okay, well, on that note, we will finish our conversation this week. We hope you enjoyed it. And if you feel you're getting any value from our conversations, then do share it, of course, with a like-minded friend. And of course, we are ever so grateful if you would take a few minutes of your time and go to iTunes and leave a rating and review, because it makes a huge difference in how we rank on that platform, and it will also help more investors then discover the Systematic Investor Series. So from Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor Podcast Series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.